with any trade that you build, you always want to use a responsible risk-reward structure. Now, trades have profit targets. They have maximum loss. Maximum loss is a very surface-orientated concept. It's basically, hey, my trade draws down this much, I'm going to leave. Structural risk is very different. Structural risk takes in a lot of different things into consideration. It takes in maximum loss, yes, but it also considers how much actual capital is in the trade. It considers the win-loss ratio. It considers how much your trade relies on probabilities in order to win, and it relies on what your assets are, right? How big are you trading compared to your assets? All that stuff is very, very important. So realize that your maximum loss is in no way a representation of your actual risk in the trade, unless, of course, the structural risk in your trade only allows a certain amount of loss. So you can't look at your maximum loss in isolation and consider your blowout scenario. You cannot do that. There's more that has to come in to play. We're looking at your maximum loss, your expectancy, your average losses, your average wins, total risk in the position. We consider the consequences for repetitive losses, the assets of the trader, and that type of stuff. So if we take a look at a bullish vertical, in this case a bull trade, we take on $27,500 of risk approximately to make $2,500. We have a risk-reward ratio of 1-to-1. Theoretically, we have a total risk in the trade of 27.5. This trade carries a lot of risk if you screw up or if you don't get stopped out at the same time. In other words, if you go in this trade and you push past your maximum loss and you decide that I'm going to hold it because, well, the market's going to come back, then you could lose that whole amount fairly easily. If you get back towards the end of if you get this a little bit closer to expiration, right, and you're near your max loss number, and you get a gap down in the market, and the market closes for 12 days because the airplane hits a building, it's gone. And you can be put protected and it's still gone because you won't be down to your put yet, probably. So it all depends on where they settle it. It's a crapshoot. Yeah, flip a coin. Are you poor or are you rich? I don't know. So that risk is really there. I can take away that risk if I trade something like this. This is an at-the-money bull strategy. It is my trade for my homework, by the way. This trade here is 1-to-1 risk-reward ratio. In other words, if I have a maximum win, I make so much money. If I take the maximum loss, it's 1W.
Just to kind of tack on there more specifically, it's 1-to-1 structural.
Structural risk, right? Not theoretical risk. This is 1-to-1 structural risk. Right. 1-to-1 structural risk. If I trade this with a $2,500 max loss or a $3,200 max loss, I cannot exceed that number.
So in the bull trade, you bring in $2.50. You're going to stop out when it's down $2.50. But you actually got $27,000 in the trade. So structural is what you really have in it. So if the market goes down and you can lose 27 grand, but you're going to stop out when it's only down 250. Right. The market may not give you the opportunity to do that. Right. So that's kind of it's not fake, but it's not a real risk-reward ratio. So what he's done is said, I'm going to make my risk-reward ratio and my structural risk the same.
Right. Okay. So this is more conservative. Yeah.
If I trade at the appropriate size. If I have $27,500 to trade with, I can't trade with $27,500. One loss, I'm done. Right? So that's structural risk as opposed to my net worth or my account size or whatever. Right? I can't do that. I literally have to trade this so that I have the same $2,500-ish maximum loss to have a representation. Okay? Does that make sense? So I have to consider my position size at that point. Now, so assuming I've adjusted my position size, this trade has a lot less risk in it than the other trade. If you compare the two, we have this. If I trade this trade with that amount of money, technically I'm safer. Now, which one has a higher probability?
I know the answer.
The bull, no? I mean, from the hip.
I don't know.
Yeah.
If you back these two tests trade these two tests from 2008, the actual at the money trade has a higher win rate. Look at this from a dynamic perspective, not from a static perspective. What does the market do most of the time?
Go up.
It goes up. All right. So it goes up most of the time. Now, I'm selling a 10 delta call. People say that's 90% probability. But what's the probability of touching that point? Probably higher. But I can't go there. I have a stop out point somewhere. If I can get my mouse to work, I'll show you. I have a stop out point somewhere around here. Meaning that if the market comes down and then goes up, so I don't really have first of all, I don't have an anywhere near a 90% probability. I have to take a look at the option at my stop out point on entry and see what the probability of that option is. And then I have to consider the probability of it touching that option. And that is my real probability statistically in the trade. Right? Now, it's not actually that because the market goes up most of the time. So,
Delta changes.
but if you're going to look at statistics and say the market is completely neutral, my actual probability in that trade is the probability, the delta of the option that's at the price that my stop out point. That's my actual probability in that trade. So I need to consider that. Now, considering that, the market can go down, the Russell can go down 500 points, and then go back 600 points tomorrow, and I win the at the money trade. But I lose my high probability trade. So the at the money vertical, I'm going to tell you the way I trade it. I enter 56 days to expiration. I will stay in it until the end. But I'll enter a second one when the next month is 56 days to expiration. If the first trade is up money at all, I exit. So what that means is if in 30 days to 60 days, or whatever, from 30 to 65 days after I entered the trade, if the market is above where I started at any time, I take it off at a win. If it's below that and it doesn't get above it, it loses. Right? That's basically what it's saying. Most of the time, the market between 1 and 2 months goes higher. Right? If you're trading the Russell, it usually goes higher. So I can make that, and I can have a higher probability trade with less structural risk in that manner if I appropriately position size it.
John,
Right? Yeah.
when you do the at-the-money trade, how much of the time is the credit about the amount of the risk?
Every time, because that's what I make it. That's how I enter
No
it.
matter what volatility is, you're going to get the same.
I enter it, so it's the same.
So what, you widen the...
No, I position
Position strikes.
a strike, so it's the same.
Move it up or down.
I
in the
see.
money.
Right?
So sometimes it'll be
So
in the money?
my put may actually be out of the money. My long put may be out of the money. If that's what it takes to get me a neutral credit.
Maybe way in the money.
I'll tell you what it is generally. Generally, it's just, usually my long put is just in the money and my short put's out of the money. In other words, I'm going to put that vertical on it and I'm going to bring it forward until it's a 1-to-1. Right?
So John, if you have 6,000, you put 3,000 in the front month, or the 56 days. Oh, yeah. Sorry.
Well, there's an interesting dynamic here.
I was trying to figure out if you had 6,000, you put 3,000 in the 56 days, and if you're up after 30.
Yep.
You close it.
You close
if
it.
you're down, what do? You put the other 3 in the
No,
back?
if you're down, you just stay in it until,
What about the other allocation of money? I'm trying to figure out your allocation. If you put the 3,000 in the back month in the next 56 days, I was trying to figure out your logic between.
right, so say I have $2,500 a maximum loss. Right, we'll just say that. Say I have a $2,500 maximum loss on a regular bull trade. I enter this position, so I have a $2,500 maximum loss, a $2,500 potential credit. Oh, by the way, the average return in that trade per year is 143%. But I can't trade a full size.
Right.
How did it do in 2018? Can I ask?
It won. Regular bull trade lost. However, 2015 or 16 was a different story. Regular bull trade broke even. This got hammered. Why? Timing. Right? Timing. Now, I could probably filter out the 2015 loss if I adjusted my timing. But I don't, but at some time, all that is filtering out the weakness of the trade.
Right.
That's going to happen again in the future. Right?
And the trade as is you're talking about here has no charting, no
No,
subjectivity. Oh,
nothing.
you just
I enter at 56 days, it comes off at a profit or expires at basically total loss. There are drawbacks. We'll talk about the drawbacks. But it's interesting. Is it not? It's interesting. So, yeah, it seems counterintuitive, right? But that is the trade. So what size am I going to trade it? Well, the thing is, I can actually overlap here because I'm still doing one trade. In other words, if I'm willing to risk $2,500 on a trade and I have $27,500 to trade with, right? I have $27,500 to trade with, $2,500 on a trade, I'm still only doing one. I'm still doing the same number of trades, and I can overlap it because I have the capital to overlap it, right? And I'm still only taking my maximum loss one at a time. See what I'm saying? So that is that strategy. Now the problem with this strategy comes in with my average win versus my average loss. How much is that strategy going to lose every time it loses? Almost every time it loses. It's going to lose everything. How much do you think it's going to win?
less than 50%.
It wins. It loses 4 times its wins on average.
Is that because you're taking those first month ones off at a small gain?
Yeah. Sometimes I get a good gain on the front month, but most of the time I'm taking it off at about a quarter profit because that's what it's at on average, right? So my loss is 4W. The good part is it never can get. I can only lose so much, right? But this is borderline to me. Borderline risk problem. But that is structural risk. That is my problem. My problem with this trade is the possibility of repeated stop outs because my loss ratio is on average is so much higher than my win ratio. That said, I am capable of making that money back, a loss and back in one trade. So, whatever. So, yeah.
When you back tested this, did you pay any attention to would there be another way to trade this, in other words, where you let you just traded on half capital and you let every trade go to completion?
I didn't do that. I took it off when it got profitable. Right.
But
That's,
do you have like a sense from looking at it what would have happened in that situation, or you don't?
well, we know that what's going to happen if we don't take the profit, right? Essentially what I'm doing by getting out of the trade if it's profitable is, right? If I look at the concept of that, I'm putting a profit target on it. Right?
Yeah,
So if I look at the concept of putting a profit target on it, that's going to lower my win rate. I mean, it's going to raise my win rate. If I decide that, you know what, I'm going to wait and let this play out, I know that's going to lower my win rate.
Yes.
Right.
I'm talking about just the flat out return.
But I don't know. I didn't actually test it. But whether I test it or not, I have to consider it working out either way. Because a lot of times I'll be up money and it'll come back. Because we're only talking, when this makes money, we're only talking about sometimes a 10-point range. Because I'm essentially in a trade that's like this,
Right.
3 days to expiration. If the price is here, I make nothing. If the price is here, you know,
Right.
it's a pretty damn good month.
Yeah.
Can I alter this back test to do it anything I want? Probably. Right? I can drastically change that by saying, oh, you know what? I would have exited here. Right? And then the next trade, when I say, I say, well, say I back test this month and the day of expiration it was here, but by the end of the day of expiration it was here, I can say, well, I would have exited here. Right? And I can justify that to myself. And say the next time that happens, during the day it was here, and it popped up here a couple times, at the end of the day it was here, you know what I'll say to myself? I would have held that. This is why when I do our back testing, I have a strict time policy so that I can't do that to myself. I say, this is the time I exit, right? Because it's very easy to do this in back testing. I didn't do this, by the way. I waited till the end of the day. In other words, I entered one 56 days to expiration. At the time of day when I entered, if it was up money, the old one came off. If it was down money, it stayed on. And every day I went, if it was up money at the end of the day, not at the end, but whatever time frame, it came off. That's the way I did it, right? So, and I didn't play it through, but essentially I could tell by charting how that would have worked out. You know how I tell by charting? I put up a monthly chart. I assume I enter the first day of every month. And if the second month is higher than my entry point, I won. If it's lower than my entry point, I lost. So I can do that. And if you want to know that, you can go look at the charts. You set it up monthly, right? And if the end of the month was high, it didn't come back down, you probably had a maximum win if the end of the month was lost. So I can go back and do a monthly chart from year 2000 or whatever, and I can pick out every 2-month period and tell what that trade would have done. It's a hell of a lot faster than back testing it. Just saying. But you see how I can do that? I'll just show you quickly the stats on this particular trade and see what you think.
You gotta have a cool name, John. What's the name?
I don't know. I was just an at the money bull. And well, we had to develop strategies for this, right? And I knew I couldn't get out of it. I didn't have a lot of time. I said, well, you know what? I looked at the chart and I said, you know what? This would win. And I did back tested it. And when I back tested it, because it's so fast to back test, I back tested it from 2008 forward.
Have you put one on live?
No, but I will at some point. You put one on live when you think the next month is going to be higher than this month.
That's right.
I wasn't getting that feeling last month. I don't know why. I didn't have that loving feeling. 2011 to 2018, right? This is the trade. So this is the trade, right? Look at the win ratio. Look at how many often it wins. Okay? Up until this year, we had a couple losses in a row. Oh, this was 2016. It's only 2 losses. It's 4 losses in close proximity. That's why that lost. And here is 2008. That's 2017. All right. So here we are at 2017. If you run the analysis numbers, right? 87% winners. My bull trade in that period is like 75%. 2 consecutive losers in a row, 84 trades, net profits 161,000. I think I had 10 lots on. And so that would be 2,500 at risk. Okay. All right. So
16,000 in a trade, if you're only trading.
right, so it's a 10 lot. It's at the money 10 lot. So it's going to have 16,000 risk. So this is the trade here. This is, when is this? I don't know. This is 2012. So this is what the position looks like when it's on. Okay, this one here isn't quite 1-to-1 because when I tested this, I didn't quite test it at 1-to-1. I tested a little less, but it'll be the same thing. Anyway, if you average it, I think it was 140% a year or something like that on actual capital. But that's the strategy. 2019 is a problem, right? 2019, I took 4 losses, I think, in a row, which is going to kick your butt.
How can you take 4 losses in a row when we're
Yeah.
17th, 18th of the year?
Well, because with 65 days to expiration, I'm already in March. So, well, hell, here, let me see what the months are. Let me look at the reports.
19 expiration, late 18.
Right. Yeah, the crash. But you know, right? This is what we have here, right? So we have all these trades, which, by the way, right? 2018. Look at 2018. Win, 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 win. And I didn't lose until November and December. I took 2 losses. That ended up being right. I have a 4-to-1 win-loss ratio. I think my average win was a little bit better there. But then I lost again for the 3rd time in a row in January. The first time I've ever had 3 times in a row losses. But that's because of how consistent and how long the down move was. And if I look at this position analysis, this is what we look like, right? So at the end of 2008, I was looking pretty good. I was up money. I was like here, right? The end of 2000, the last trade I did in 2008 was here. So I made money for 2008. By 2009, no,
2018.
yeah, 2018. My 2019 trade, the first month, dropped me back down to break even for the year. But how bad of a strategy is that? You know, I just lost my profits for the year. But but the structural risk in this trade comes from the fact that my win-loss ratio is 4-to-1. That's where the risk in the trade is, because I have a risk of repetitive losses taking away, 3 repetitive losses, because theoretically it's going to take away 12 months of gains.
So, John, what size of account would you use for this? What account size? I saw you
Well-
4 losses of 16,000. That's
Well, if I trade, like I said, if I was to trade a bull trade with 27,005, I trade this one with $2,500. So about 1/10 the normal size of a trade. You size by your maximum loss.
back.
Yes, I have 4 losses back to back. So how is that going to affect your accounting? How's that going to affect your?
You need $64,000 to cover that, right?
Well, if you're trading 10 lots, right? But if I'm trading $2,500, I only need.
How much are you willing to lose in a month, calendar month, and then back into it from there? So if you're willing to lose,
Well, put it this way: how many trades in a row can it lose?
Probably 6.
No, it can lose an infinite number.
infinite.
Nobody knows, right? What if we go into a market downtrend and it just never bounces for like 6 months? It probably wouldn't happen. I can keep myself out of that. I can apply a filter, right? I can put in a bull market filter and pull out of the market so that I don't hit a downtrending market environment. But if I do that, I also would have been out of most of 2018. Most of 2018 was pretty good. So I'm just giving up opportunity. If I want to take out the possibility of losing 6 months in a row, and I know the weakness of the trade being a down move, if I want to take out that possibility, I put in a market filter that basically, if we're downtrending, and I can do it in multiple ways, I don't trade the trade. Right? I wait till we're solidly uptrending to trade it. Again, that pulls opportunity away from me, but it does fix the problem of potentially having a lot of stop-outs, because realistically in an uptrending market, that's not going to happen. I might lose once in a while in an uptrending market, but I'm not going to lose repeatedly. I'm only going to lose repeatedly in the down market. So if I'm willing to give up the opportunity to do well, like, even now, I had this terrible period, right? I had this terrible period. But if I go from the beginning of 2018, I'm no worse off, right? I know Sherry's saying move on. I'm no worse off. Does that make sense? So I don't see that as a terrible thing. I can put some sort of a metric to say, you know what, I'm going to stop trading here. If I go into a downtrending market, I can put a metric in to say I'm going to stop trading until I know the market's uptrending. Have some sort of metric. That's not a guarantee, but it was, it's better than losing forever. So this is what you need to think about. When I look at this trade, I say, well, I could go down. I mean, the market could continue to go down, right? We could go into an era in this country where the stock market goes down for the next 6 years. I don't know, right? And if I want to do that, I can put in some sort of a filter to filter me out of that, because I know that's the weakness of the trade.